Okay, welcome back to another edition of our morning mailbag. This is Coach T, where I take questions from our users, and this is part 2 from Christian Lungebeck. And Christian had a question about credit spreads. I want to just kind of read this out loud. When placing a credit spread, we have a high probability of keeping the premium, but we also have a negative risk-reward ratio. Naturally, it doesn't make sense to let one losing credit spread wipe out 5 successful ones, because I want I want to exit my credit spreads before the loss exceeds the credit sold, and preferably even before this. But when I build and analyze my trades, I find that most of the time the stock can only move a few percentage points in the wrong direction. I'll give you an example. Hit an example on a Google bear call spread. This was from a few weeks ago, so I'm going to update that with current numbers, and let's talk about it. So let's go in here into the Analyze tab, and let's build Google. And let's look at the chart. Here's Google. Broke out recently, so it may not be a great credit spread for a bear call, but good example of what we're talking about. There's resistance here, about 570. So Christian, if you were putting it on this today, for a fill, what you would do is you would go to simulate the trade. I like to build my trades in the Analyze tab so I can look at the risk graph, and then I'll send them to the Trade tab. I'll show you how to do that in just a minute. Traditional rules for a credit spread would put you about a month out, less maybe, up to 60 days. There's a lot of variables in there, and traders tend to change, depending on market condition. The other thing about it is you may use a 20 delta, 30 delta, 10 delta. Part of this design has to come back to your own individual system. Let's start with the 35-day March option, which would be traditional. Scroll this all the way down, watching the delta, and use this 21 delta right here. I'm going to build the bear call by clicking on the one bid price, holding the control key down, and clicking on the asking price. It builds the vertical down here correctly. You know that it's done correctly if it says vertical and credit. Okay? If it doesn't say those two things, you did not build a bear call spread. It should also say calls, read to make sure your strikes are right, and set your option defaults. By the way, the option defaults in Thinkorswim are set to 10 contracts, I believe, because I like to start at 1 and then add as many as I need to based on position sizing. What I do is I change the option defaults to 1 right here. It's in the, if you saw that pretty quick, it's under Application Settings, Order Defaults, Options, and then you'll find that right here. Now here's our spread. Okay. Now sometimes the risk graphs get funky. I don't know what the data is with that. I usually just click Reset at that point using this little menu, and then it will show me my spread. Now what Christian is talking about here is pretty traditional. In this example, we have $80 potential profit. This is our profit here, and $420 potential risk. If you don't know how to manage credit spreads, that's a pretty tough deal to handle. All right, let me show you a theoretical risk graph over here in Paint. So we only have 80 profit and 420 risk. Now, the only way that you can trade credits this way, which is something that almost every mentor is going to recommend that you do, you learn how to deal with this relationship, is if you get into good probability. What you're essentially saying is that I believe that from where the current price is right now to where my break-even point is at expiration, that cushion is giving me enough probability to make the trade worth it. 80 bucks on 420 risk is about 19% ROI. You get used to doing those numbers real quick. But how do we deal with that? How do we come up with a plan to exit it, to deal with it, to control it, all that kind of thing? Well, the first thing is this number down here, this 420 risk, has to be factored in that it can potentially, theoretically happen. And so that can't exceed your money management. You should max position size at risk at about 4% max at account. Some people will keep this as low as 1% assumed risk, and that is when you're getting out, where are you going to take the hit? keep it conservative. You know what I tell people, especially when they're new, is that if you position size well, if you learn how to money manage well, you'll stay in the game, you'll make money. Every trader takes a lump on the head every now and then. That's a natural thing about trading credits. You do take on more risk than credit, and so you have to assume that eventually one of those is going to happen, whether it's a gap or you just fell asleep at the wheel, didn't manage it, whatever it is. You will take some risk at some point. But it's still a good system, and you can still make money if you choose to trade credits. So what can we do? Well, when you're building it, by coming into low volatility environments, which is what we're in right now with a lot of the options in the market, with the market rising the last little bit, you don't have a lot of inherent cushion. In fact, from 550 to 570 is only 20 points. With the ATR at 10, you only have about 2 ATRs cushion. If we had Bollinger Bands up there, it's probably at the top end of the Bollinger Band. If we had the probability cone, it's probably inside the cone. Some people would not feel comfortable that that's enough cushion to manage their trade. So one of the first things you can do in a low volatility environment is simply, instead of playing March, which would be your first kind of guideline that you'd want to follow, if you're not getting enough cushion with your traditional guideline, go out an extra month. There's nothing wrong with that. In fact, many traders prefer to go 60 days out when they're trading credits. Now, that does not mean at all that you're going to hold for 60 days. But if the environment is forcing your hand so that you can get cushion, this will put you in a position of safety a little bit more. Now I'm going to change one of these columns to delta. Need more than 14. Looks like we'll need all the strikes. 21 delta here. Bid, now we're at 590.95 instead. So here's our risk profile. We now have more cushion between the current price and our strike price. Here's a neat trick as well. If you learn to use the slices and you set the slice to break even on your expiration, you can then set the slice to your chart, and it will show you this long horizontal line is where that break even is. Now here's the trick, Christian. You'll see two lines. By going out to April, it doesn't mean we should give it more of a leash. In fact, we should still exit here if it broke that resistance. Because if it breaks that resistance here that was set in October, it's clearly in an uptrend. We're clearly on the wrong side of the trade, and so we should base a plan around 570. Well, in the Analyze tab, I can then add a slice at 570 and then step this out over 4 separate days, kind of a 7-day step. And see these numbers down here, this 214, 21, 28, 7, and 14. It gives me a time rainbow kind of as to what the risk will be at 570. And if I get my mouse set perfect and just kind of drop it, that's fine. That's good right there. Somewhere between $36 and $67. So let's say we assume a risk of 50 bucks. Okay. Well, what can we do? What can we do? Well, we can, if we're creating the order, duplicate that order out, change it to a first triggers a sequence. We'll just set a stop loss and add that stop loss back. Stop to market. I usually stop to limit. Stop it at 150. Base this on the distance in the spread here. By the way, I know this one's an advanced video. I'll do some basic videos too. All you got to do is make a request, you know. I like doing these. They're a lot of fun. So I know sometimes we go quick, sometimes we slow it down. Hopefully we're hitting all audiences. If anybody has a request, just hit us up on Twitter or team at Tackle Trading or in our clubhouse. Now, if I'm looking at the distance in the spread, this helps me understand where to set my limit here. Sometimes it's 10, sometimes it's 20. Got to drop these windows down. So the 590s has 30 cents, and there's 30 cents here. So probably what I'll do is I'll add about 30. I might sometimes even add more than that to come up with some rough idea on how much I'm willing to risk. Now, if I sell a credit for $1, okay, let's go back to our risk graph here. So this one, we got to change our amounts. So if we change to April, now we had 100 credit and 400 risk. It changes that dynamic. If I know that from where my entry is, to where my exit will be. And let's get the prices on the chart here. 550 to 570, still not going to give it that much cushion, but if I do 550 to 570, that's a $20 cushion, but more importantly, that's a stock price cushion. My actual dollar risk is somewhere between $50 to $80 assumed risk. That's where I'm setting my stop loss. Then I can just multiply that out, multiply by how many, now I can figure out how many contracts I want to trade. If I want to trade, say, I don't know, $500 risk, I might do anywhere between, at max 10 contracts, might even just do, say, 6 contracts based on that $80 assumed risk. So then I can come back in, and in my Analyze tab, everything should be saved, and set this to 6, let's do 6 contracts, and the stop loss, got to double check that as well. Always check your time and force to good till canceled. And there's an example of how we can set things up in advance to control the risk. Now, let's go ahead and pop that in there, send that off. One thing you'll always want to do is make a notation on your chart. So come over here to Drawings, Text Note. Just simply write up here, say entry at $1, April 590, 595, stop at 150, 180. Okay, and I'm going to say risk graph at 570 price, and I'm going to say even earnings are about April, it looks like 14th. In April. I'll just put April because I'm not getting the exact date there. There's a trade, guys. Credit spreads require some kind of organization, some kind of management. You have to have a plan. You have to have an exit plan. You'll notice here on the chart it's now showing me where I'm trying to get filled at $1 and where I'm willing to stop out if I'm wrong, at $1.50 by $1.80. This has been another edition of the Morning Mailbag, where I answer your questions, whether they're simple, advanced, Forex, futures, options. I can even answer questions on life, guys. If you want to know about existentialism or self-actualization or I can, anything, I can definitely do it. We have a lot of fun here at Tackle Trading. I know the content can get quick sometimes, but there's a lot to learn. So, post us up on Twitter at Tackle Trading. In the clubhouse, become a member, and those questions always take preference from actual members of the Tackle Trading team, or email us at team@tackletrading.com. Get in the game.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.